You're in the Business Insurance Zone with me, Steve Savant, national financial columnist and money color commentator. This week on The Biz, Premium Financing Series, and on today, critical executive benefits using premium financing with certified financial planner Bruce Haydu and attorney Rick Veit.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And we are in day 5 of our Premium Financing Series. And if you're coming to the show today, I just exhort you to go back to Monday's show and watch it in succession. We're talking about a very technical area, but we're doing it in a very entry-level idea. We're trying to be nice and kind and friendly. And I want you to go back and watch these in succession so that you can really learn the building blocks of premium financing. And today, I have to say, we are really going to do something completely different. If you've been with us the last 4 days, we're going to talk about something that's even broader application to premium financing. And we have back again, we have Bruce Haydu and Rick Veit. And we're going to talk about, this is really, and I have to say, this was kind of new to me. And I think 30 years I've seen everything. I guess I didn't see everything. We're looking at using, on a smaller scale, for executive benefits. And the thing that blows my mind is we're talking about some issues of no recourse, no collateral. Talk to me about this. I mean, I'm in shock. I mean, I thought the bigger boys, if they have to have collateral for the last 4 days, why wouldn't we have to have collateral if you're at the lower level? Talk about that.
Well, the big distinguishing factor here is that there's no collateral. There is some money paid, but that payment is limited to 5 years, and then the client or the insured is done. For every dollar that the client puts in, $3 are financed from the bank. And that puts much more cash into the policy. The policies can be as little as $1 million, so many more people qualify. As Rick said, probably 7 to 8 times the size of the market. Business owners, executives, as long as they make a minimum of $100,000 a year, they can join the master trust, and there's about $200 million of face per each trust. And we've closed 2 trusts so far. We're working on our 3rd. And these benefits flow. Death benefit, income if you're under age 55, death benefit only if you're under age 65, so this goes up to age 65, and a host of other benefits too.
Oh, I'm thinking about this. You know, Rick, we were talking about some of the higher end the last couple of days. And this is bread and butter small business America. I mean, this has application that is, in my view, quite different from the demographics we've been talking about for the last couple segments. So introduce me into the mindset of the business owner, and am I going to play with his fiduciary? Is his attorney going to be talking to us?
Yes. The potential market are everything from professionals like lawyers, doctors, accountants, to the guy that has a couple plumbing trucks, to the franchise owner. If you're an owner or a senior executive or employee within that, you're a potential insured for this. The thing I like about this is as an attorney, I've done many buy-sell agreements over the years, and it's hard enough to get them to buy the insurance to fund the agreement. Because if it's not funded, it's a useless agreement. They basically paid me and they're getting no value out of it. But you're 7 or 8 times more likely to be disabled or become sick with cancer or have some kind of a chronic illness than you are to actually die. If they can barely get them to buy the life insurance to fund it, forget getting them to buy disability or some kind of chronic care coverage or something like that. Because of the riders and the way this is set up, it's virtually painless to now put these policies into place using leverage, the bank's money primarily, in a tax favorable way for the business. And oh, by the way, I've covered my disability or my chronic care or my terminal illness needs as well, all in one package.
And that package, if I understood you right, it's a 5-year plan. So once the 5 years is over, I'm paying the bank back. I have a cash value contract that has these associated morbidity riders on it, and I'm done after 5 years.
It's close. You're done after 5 years. The funding continues for 10, and generally we take the bank out at about year 15. So the client is finished after 5, but the bank continues to make the other 5 years payments. and we take the bank out so that all those benefits are available within about 15 years.
A quick example, if you're a professional athlete, you're the ripe old age of 35, getting out of the business, you can pay as little as $23,000 a year for 5 years. The bank is going to match that alongside, so about $50,000 for 5 years is going in between you and the bank. The second 5 years, all 50 is going into the bank. The athlete, in this case, gets the minimum $1 million death benefit. If they hold the cash value until age 65, it's $121,000 tax-free per year. They also get disability coverage of up to $20,000 a month. They also get long-term care coverage up to $1 million, and they get critical illness coverage of up to $1 million, all for about 1/3 the price than if they had to fund these separate benefits on their own.
So in 5 years, it's fully funded by the client himself?
Correct.
Yes.
So he has to be in it for 5.
And if he's a professional athlete, he can dump in
problem.
less than the 5 times 25. There's a discount.
And it's
associated.
non-recourse.
And this has been a big appeal in the market? You've seen this
Huge.
go?
It's going to explode.
Yeah.
Absolutely.
So 5 in for the client out of pocket, but after that, the bank's,
it. They're
and
done.
then the bank's out in the 15th year.
No collateral.
Right.
Wow. When we talk about this, seems like a smaller level, no recourse, which surprises me, no collateral.
Correct.
You have your skin in the game because you're making your
Yes.
payments.
Right.
And we're talking about funding morbidity issues of long-term care, terminal illness, disability, because we're using a rider on a cash value contract.
Correct.
Yes.
See, to me, that is wild to try to think about covering all three: death, disability, long-term care, terminal
Possibly
illness,
income.
possibly income. I mean, to me, that's where I like see the roll-up on this, and the application is way broader than the things we've been talking about the last 4 days. Wow. Well, listen, when we come back, we're going to talk more about the whole week. We're going to try to summarize it if we can, and we're going to talk about how this can be an impact on your business. And don't forget to go out to iuluniversity.com for the best training, education, and sales support
You're
when it comes to
listening
life
to the
insurance.
insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Bruce Haydu, and we're talking about premium financing all this week. And remember, you can go out to our site at thebiz.tv and pick off any of our chart toppers that are out there today. And we have a lot of carrier exposés and a lot of information. You want to go out there, just hop out there, thebiz.tv. And just a heads up, before moving forward with any of the ideas you hear on our show, especially this week, consult your tax advisor, and if you're FINRA licensed, your broker-dealer compliance department. We're going to summarize the week this now, Bruce, because we've really talked about a lot. And one of the things I want to talk about is, remember, out of all the major plans, there was about 10 to a dozen plans over the last decade. Yours was the most conservative. And because of that, no banks withdrew their funding from you during the bad boy market meltdown of 2008. Now, that's a big trumpet issue here.
The reason is that they did not perceive the same risks to our program as they did with our competitors. As a result, we never lost our funding. In fact, fourth quarter of 2008, we received an extra $7 billion of capacity for new lending. And that number has been increasing each year. So that's a testament to the design of the program.
And when you talk about top banks, and really, we're talking about domestic and foreign banks. I mean, this is a huge market.
Correct.
I've noticed that that has become your better reference point. You think you'd go to the carriers to get reference points for agents or fiduciaries, or the client, a high net worth client's going to go to the carrier, or maybe he's going to go vet the agent. But really, the banks are your big supporters.
Absolutely, and as Rick said in a previous date, the banks are our best references. They do extensive due diligence, and they have to be sure that their money's safe when they're lending it. Who are the carriers? How are the policies structured? Who are the teams behind this, and will they service it properly? We do annual reviews. We tell the client each and every year how they're doing, whether they're ahead or behind, so the client never forgets why they did it, unlike other methods of selling where the agent sometimes disappears. Right now, if I'm reading the script right, you did $3.5 billion in loan commitments that are out on the street right now. The program has done that to date, that's correct. Now when I think about that kind of number, and about almost, I think there was another stat, 55% or 50% of all of your cases that are out there are above plan. Right, and above plan, or plan, means that when we design a case, we set spreadsheets out to age 100. How much death benefit will be, what the loan will be, what the interest rates will be, what the cash value will be, what the collateral will be. So if everything went according to plan, every year those numbers would all line up. Nothing goes by averages, and sometimes the numbers vary. 5% of our cases, 5% of our cases are off plan. Over 50% of our cases are above plan. So none of our cases are more than 5% off plan. That's all it is, 5%. So the collateral makes up the difference to keep the satisfaction for the bank. That's the lever that has to be adjusted when necessary. Another thing we talked about this week was we can't just let any carrier do this. We have to have highly rated carriers and carriers who actually understand premium financing. Correct. They have to work with the program to make sure that the policy is the correct policy. There are plenty of shelf indexed universal life carriers with policies, but is their options desk robust enough and efficient enough and low cost enough to give us the low cost ratios that we need to build the spreads into our design? Yeah, you made a big point of that a couple days back in our show, because I see a lot of carriers, and we've been in a lot of home offices. I'm thinking of a carrier that has a complete floor of option traders. The whole floor is just option traders. That's right. Whereas I've been to other carriers where they have two guys in a back room. The economy of scale is important because it reduces the cost of each trade, which is important and translates to the bottom line of the policy. Well, when you think about the strategies, and I have to tell you, my mind was really opened here this whole week. Estate planning needs for using premium finance, I got that, I understood that. But then we started getting into multi-generational wealth transfer, which we talked about a couple days ago, which could be huge. And I believe Rick said this is a major exploding market. Well, you have to be worth $40 million and up, and God bless America, there are many families in this country worth that amount of money or more. What do you do if you're over age 70? What if you do if you haven't done your planning? You are uninsurable. Multi-gen is for them. We can insure the kids and give a lot of benefits to all three generations by using multi-gen. And we also talked about this week about dynasty trust revitalization, because I'm seeing a lot of trusts now. We're just about ready to exhaust the funding. Right. This is a great way to revitalize family trusts, dynasty trusts. Trusts tend to be depleted the more you distribute income to generation after generation. The program, PFLI, Premium Finance Life Insurance, insuring trustees or beneficiaries, 35 to 65-year-olds for $10 million plus each policy, all of those policy face amounts can pour back into the trust to revitalize it. And where does the collateral come from? The trust itself. Then we're talking about charity. We talk about charitable giving. I mean, this is a huge issue to be able to help a charity in the now, not just the later. We structured an idea called the gift that gives back. Imagine you love your charity and you want to help them. Well, you can take out a PFLI policy and wait until you die, and maybe 20, 30 years later they get some money. Right. That's wonderful. That's an endowment. But what if you wrote a check to them today for $1 million? They'd sure appreciate that. In coordination, you do your PFLI and give them maybe half of the death benefit down the road and the other half to your kids. Your kids won't begrudge it. I love it. PLFI, Premium Financing with Life Insurance. I mean, that's what we're talking about today. And it's also using in applications in business succession.
executive bonus. I mean, there are so many applications to this with a high probability of actual success. Right. Remember to watch the entire week's show so that you understand it. Just go out and hit our red on-demand button right on our show's homepage at thebiz.tv. That's the buzz on the biz for today. Get in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.